Welcome to TheoTrade. This is Don Kaufman. It's February 15th, 2023. There's just about 20 minutes left inside of the trading day on this Wednesday afternoon with markets, well, just grinding. For the most part, though, the S&Ps right now are what we would term massively unchanged. All right, so in the last few weeks, we've heard from everything from non-farm payrolls, which was some stellar numbers. And of course, earlier this week, we had CPI, right? Which came in a little bit hot, similarly to the non-farm payrolls. Then today, we even had retail sales coming in at like 3%, well above expectations. You know, the question that I've got over here is, will markets hit a wall of economic reality? And that reality, unfortunately, is likely to be the Fed. So I'm going to give you a little bit of a brief update on a couple of trades that I am likely to take, some of which I already have on, but a few trades that I'm likely to take in the coming days. I'm actually going to set those up for you here on this evening's video, and we'll go from there. So let's get started with the fact that, as I said, the S&Ps are massively unchanged today, but there is a little bit of concern on my front. Like dollar, it's ripping. I mean, look, the dollar, it's unequivocally, it's trading to the upside. And when we've seen this kind of upside momentum in dollar, it's been a little bit of, if you will, duck and cover. And what I mean by that is, hey, look, let's just, call it what it is. A bullish dollar has been a bearish signal for the S&Ps. Clearly, that is not per se the case in today's trade, but it is an area of concern. Now, with that, some sell-side activity has been hitting the bond market. Now, sell-side activity in the bond market, the note market, means rates are going to be slightly higher. Let's go take a look at the TNX. Right, TNX, just, bottomed out here at about 3.3 and change, and we're ripping right now all the way back to 3.8. I mean, this is, look, any way you want to put it, it's a big boy move inside of the 10-year interest rate. And at what point is this move up in interest rates going to really start to tag specifically tech, big tech, the monsters of tech? And, at this point, again, I think that markets are taking a very guarded stance. And it's one of the reasons we see trade is buying dollar. Trade is buying dollar. It's not a good sign for the S&Ps. And again, I'm not trying to bear up on you here, but I guess the stark reality ahead of us is that some of the economic numbers, they're still far better than anybody would have anticipated. The CPI comes in hot. That's clearly a sign that, like, hey, inflation is not cooling off. Dun, 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 here comes the Fed. So, put your hands up. The Fed is coming. The Fed is coming. And that's something that you're going to have to consider in the very near future. And that's why I say, I think, markets are likely to hit some wall of economic reality. And the economic reality is that what's going on here in Wall Street can be detached for a significant period of time. Again, I talked about this extensively last week. It's a rally. The only reason that anybody gives a crap about this rally is because it's, it started at the beginning of the year, right? And that's it. I mean, if you really want the truth on that one, it started at the beginning of the year, because every other rally that persisted last year, and I'll zoom out and actually cruise over to the spiders for a second. If you look at last year, the point I made last week is the rally that we're in right now was nothing compared to the rally that we saw from October to December, was nothing compared to the rally we actually saw. It really kicked off kind of like late July and went into almost the September timeframe, was nothing in comparison to this one in March. I mean, every one of the rallies that occurred last year was bigger and brighter than the present rally. And I was asking the question last week, so why is now any different? And here's the crazy part. Now the economic data coming out right now, in many ways, is better than the economic data that was coming out, in the midst of the beginning, if you will, of interest rate hikes. So, put on your big boy pants, because get ready. The Fed is again, they're coming. And I think we're going to hit a wall. Now, when are we going to hit the wall? That's where I kind of shrug my shoulders and go, I don't know. Okay, I don't know exactly when we're going to hit the wall. But I'm going to tell you one thing right now. I'm going to go out and I'm going to position myself Okay, what I feel is going to be very effectively for that. A couple of trades. Number one is going to be in Caterpillar. I think Caterpillar probably already had kind of a key reactionary, like 266 reversal in here. So kind of a big key reversal right and around the 266 level. I'm not a market technician, but that is in the near term in a downtrend. With that being said, what I'm likely to do is go to about 65 days out. And I'm going to look again. I'm going to look to buy, if you will, a Caterpillar put spread. Okay, so here is a $10 wide put spread. Done. That's it. So I'm going to buy this for about 250 bucks. Okay. Now, how am I actually going to do it? Oh, I'm going to go out and buy it. But I am going to tell you that I'm going to do what's called catapult that particular trade. What a catapult happens to be is I'm going to finance the Caterpillar trade with a catapult strategy. The catapult strategy goes out there and it'll actually sell S&P options on futures to finance the Caterpillar trade. I'm also going to do the exact same thing in a product called none other than Starbucks. Okay, so I'm actually picking quite the little spectrum of stocks. Caterpillar, Starbucks. Okay, so if I go out to Starbucks, all right, now Starbucks, I just don't think I can time this one. I mean, Starbucks has been incredibly resilient. There's no fade in here whatsoever. Look, they actually announced earnings, maybe not that good. Doesn't matter. Stocks actually popped back to the upside. Nevertheless, eventually, okay, the consumer will fade. That's, my estimations. The consumer is going to fade. We're going to hit again the wall of economic reality. And for this trade, I'm going to go all the way 93 days out, which is that's crazy for me. So it's crazy. I mean, it's a distance for me. And I'll go out here and use a spread, another $10 wide spread, put spread, if you will. And this is not about me bearing up. This is about me taking very strategic shots 93 days out in this particular case. What am I going to do? I'm going to pay $230 for the one lot in here, but I'm going to go out there and I'm going to finance it using S&P options on futures. Catapult. Catapult, okay, is a strategy that actually seeks to finance spreads that I want to buy, spreads like Starbucks. Okay, I've got a whole Catapult portfolio, and anything in the Catapult portfolio has been 100% financed by the sale, okay, of out of the money puts and or out of the money calls, corresponding to the underlyings. Now, everything that's really profitable has been closed, but all these trades in here, and Apple and Caterpillar and FXI, and you can see I've already got a Caterpillar trade on, and QQQ and Target and VIX and XHB and XLE, and I tell you what, I have a whole entire another portfolio here. Okay, over in Tastyworks, I've got another entire portfolio filled with more Catapult. Goldman Sachs and Intel, and again QQQ. So this is not something that's brand new to us. I'm financing positions by selling other positions. So with that, so again, a longer duration position in Starbucks. Last but not least, today is not the day to do it, but if I take a quick glance over at Microsoft, I got to tell you, I want to be in the short Microsoft business right now because this thing has just been a blistering move to the upside. It's Chat GPT hysteria right now. And again, similarly, I'm probably going to go about 65 days out, somewhere maybe that 260, 250 spread. Again, trading for about 285. What am I going to do? I'm going to buy it for 285. I'm going to finance it with a Catapult, and that's pretty much on the docket right now. Again, you can go out, you can buy all three of those spreads, and I'll probably have less than $1,000 at risk for some nice out of the money shots. And if we collapse back down in the next 60 to 90 days, you're going to be gold, Jerry, gold. If we don't, you're going to lose almost $1,000. Frankly, I think it's worthwhile. But me, I'm not only going to go out and buy the spreads, I'm going to finance them. Okay, I don't like paying for things up front, so I finance it. Look at this. I've already made 50% of these 3,000 puts. Okay, it's almost over and done with. All right. So those are a few trades that I'm actually looking at because again, I'm looking for the wall of economic reality to hit markets. Last thing I want to mention, kind of halfway through the week here on this Wednesday afternoon, there's 10 minutes left in the trading session, and I like to look at the SPX. And the reason I like to look at the SPX is the SPX this week, okay, was anticipating this pretty immense move. There's no question about it. So in the previous week, we were looking for, some like $70 plus move. This week, we're looking for plus or minus $104. Thus far, what have we moved? You started the week down here, just below, and I say down here, this central line indicates where the week started. This is the upper edge of expected move and lower edge of expected move. This upper edge and lower edge are precisely $104 lower, $104 higher. Okay, that's what expected move is. It's just a standard deviation. Okay, that's a one deviation move on either side. Anyway, with that being said, actual move over here, what do you got? You got a market that just moved from 40.90 to, let's get crazy, 41.40. You got a 50-point move. All right, so where are we right now? Halfway home. Okay, but the way I see it is we've done absolutely nothing. You got to anticipate Thursday and Friday this week. Once again, this is going to be gamma terrific. What that basically means is there is a proverbial crap load of risk that's going to be facing us on Thursday or Friday of this week. Get ready to rumble. I said this last week, and I got to tell you, all right, I said it on last week's video and last Wednesday. I said, get ready to rumble. We're going to make a big move. And Thursday moved right down to the lower edge of the expected move. Friday actually tagged the lower edge of the expected move. Much of the same. Does it mean, do we have to hit the lower or upper edge of the expected move? The answer unequivocally is no. We don't have to hit it. Okay, but there's an incredibly high probability that we're going to reach for it. Now, that upper edge corresponds very close to 42.11. The 42.11 would actually be referencing the S&P futures. Okay, so just be aware of it. Again, if we do break to the upside, those S&P futures are very likely to trade right in to what we term an upper gravity point. And again, I want to actually put some levels to this. To the upside this week, okay, is 42.11. To the downside, the first stopping place here would be 41.06. That is a level that I've now marked on my screen. 41.06 does appear to be a gravity point. We came just shy of it. Obviously tagged it the prior day, tagged it the day before that, but it's been a very key inflection point inside of trade. So just be aware of it. All right, that 41.06. I have to tell you, right now, I mean, look, I'm talking about bearish positions because no matter what you might say about this marketplace, it's gone a long way. It's gone a long way in a relatively short period of time. You could comment all day long till we're blue in the face about overbought conditions, but there's no question that we could rip right to that 42.11. Getting there, yeah, no, I would definitely bear up. But in the meantime, I think a lot of traders realize we've stagnated. I think the easiest place at this point in time to go is to the 41.06. From 41.06, I'm going to have to reassess. Nevertheless, I'm going to be placing those trades in Microsoft, Caterpillar, Starbucks in just the days to come. So sit back, relax. Again, let markets move. There's no reason to force trades in bad conditions. Okay, we can absolutely trade. Let's trade in viable condition. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.